Good morning, traders. Today is Thursday, September 22nd. Welcome to this live intraday strategy webinar on the heels of yesterday's FOMC interest rate decision. Lots to talk about. Good to be with you guys in the room here today. I'm going to jump right in. There's a lot to cover. So as always, guys, if you have any questions, trade setups you'd like to review, strategy questions, you're in the right place. Feel free to throw them on the message board. Good morning, Eileen. Happy fall, she says. Golly, fall already, right? Finally starting to get some cool temperature here in New York, so it's a welcome change for me. Adam, good morning to you as well. Alan wants to take a look. Can you take a look at the Aussie 200? I've been trading it from 51.80, taking profits as I go. I have a target at 5,500. What do you think? Aussie 200, we'll take a look. Let me jot that down. Okay. All right, so what did you guys think of yesterday's interest rate decision? Kind of right in line with what we were saying. Conwall was saying, hello, Michael, good morning. Yesterday, I understand where to place stop loss. Thank you. He's saying thanks to yesterday. Conwall, more than welcome, man. And again, our job here is not necessarily, guys, just to put you on the right side of the trade, but also sometimes to steer you away from trades that might not be in your favor. So I appreciate that, Conwall. So the FOMC, good old Yellen, coming out with a hawkish tilt, obviously, but still continuing to hold rates as expected. The main highlight, obviously, yesterday was the interest rate dot plot. And I highlighted this for you. I tweeted it just a couple of seconds after the release. The major focus that you saw here in the difference between the September and June reads was the dramatic reduction in the spread that you saw for the 2017 expectation for interest rates. So you see that the median estimate dropped from above 1.25 to below 1.25, basically just above 1%. And you have a little bit more of a cluster of Fed members that see interest rates sub 1% into 2017. Remember, last month we only had one member seeing interest rates below 1% heading into next year. Okay. Also, the longer run or terminal rate of interest rates, which is sort of the normalized rate, has also been reduced. And you see a dramatic drop here from Fed members thinking that we could get as high as 3.75. Now only one member seeing 3.75, the majority right here at 3%. So certainly, what does this mean for Fed policy? And this is a good question that we were discussing on the desk yesterday. Nothing's changed, guys. If we take a look at Credit Suisse overnight, or Fed Fund futures rather, we're still looking about 61%. They've now dropped back down to 58%. If you look at the updated Fed Fund futures, now back down again to 59% or whatever. But the point being, the timing for the next interest rate wasn't at question yesterday, right? Everyone's still expecting December. What changed was because of the dot plots, now the pace of interest rate hikes is being suppressed. So we all are expecting December. We're still expecting December, but now after December, it's not going to be those 3-4 hikes that we were expecting next year, right? In fact, most Fed members are starting to tone down those expectations. So that's what the market's reacting to, and that's what we kind of tried to highlight here in the webinar yesterday. A question here saying, glad for your heads up on the FOMC with the trades on the dot plot and presser waiting. As for the info, surprised me though that they get the rise out of the way, even so. And to reduce the long-term and to reduce the long-term, fall is starting with a fall. I would agree to that, but Eileen, we have to take things in context, right? Not only did they reduce those, but if we look, let's take a quick segue. Bear with me one second. If we take a quick look at the projections, okay, we can see that there was also a downward revision to the core PCE number, so the inflation numbers. And I said this yesterday in the report, last quarter, they upwardly revised this from 1.8 to 1.9 for the June projection, okay? They dropped it again to 1.8. So what does that mean? Well, it basically suggests that they're seeing a softer inflationary outlook. With their inflation and dual mandate for price stability, that gives us That gives them more time, essentially buying time to be able to hold rates. The other side of the coin that flipped yesterday was during the Q&A section when Yellen started to essentially, I hate to use the cliche move the goalpost, but basically now start to reflect back onto the employment numbers, which as we discussed yesterday is essentially pretty much near what the Fed is looking for as far as the nominal rate of unemployment. Here's the unemployment rate. Again, they're looking for a 4.5, 4.7 clip. We're currently right around 4.6. So she took a step back and said, look, although the headline unemployment rate is there, you're seeing that household wages haven't moved up as much. You're seeing that there's a lot of still pressure. We've seen an uptick in the labor force participation, but we're still at pretty subdued levels. So now they're starting to buy themselves some time on the employment side too. Long and short of it, guys, again, we're not going to be complete fundy freaks here and really focus on this so much, but I just want to impress on you why the dollar has done what it's done. Okay, it's not because expectations for the next hike has been pushed out or anything like that. It's just that the pace of normalization moving forward looks like they're pushing that down. Okay, so what does it mean for the dollar index? Here's what the dollar index looks like as far as performance heading into the U.S. session. You can see that it's weaker against all its major counterparts. Biggest performer is the CAD, loonie up 0.75%. We will go over dollar CAD later today. Keep in mind tomorrow you do have retail sales figures as well as those CPI numbers out of Canada, so certainly something to take a look at heading into the close of the week. Conwall says crude. Yes, we'll take a look at crude as well. Let me write that down. But we'll be keeping an eye on that top performer today. Worst performer on this session, Japanese yen down 0.27%. I actually was in a long dollar yen last night. I'll show you that in just a moment. Took off 3/4 of the trade. The last quarter got stopped out at break even. Aussie dollar also had a trade on that last night. Got stopped out at break even on a short there. British pound, really nice strength. That was a trade that we took right in the back of the FOMC. I closed out a good 50 or 60 pips on that one. We'll take a look. And Kiwi, again, also coming off of the initial resistance that we talked about yesterday. Okay, so we'll go over that. Sushil says, where did you get this graph? Sushil, which one are you talking about? The interest rate dot plot? Or are we talking about the projections? Here's the link for the projections. These are the latest projections that came out yesterday, guys. Sushil, there you go. He says he's asking about the projections. I just sent you the link. Okay, so these are the latest projections. Also goes over central tendencies for GDP, unemployment, inflation, but most importantly was that dot plot. And again, I made that graphic for you. So here's just a side-by-side comparison of the dot plot from June to September in last night's report. All right, Sushil? So for the dollar index, here's what we looked like yesterday. As we noted, the downside bias remains intact. Keep in mind that yesterday constitutes an outside day reversal off of resistance. We noted this last night. That just means that this candle overtook the previous day's highs, took down the previous day's lows, and the previous day was an up day. So it's an outside day reversal off of critical resistance. That, my friends, is a bearish development. And I kind of just basically just blurted that out here yesterday. So what does that mean for this for the dollar index? Look, you could get some back and fill here. Oh, I'm talking about the yen weakest and the strongest. Oh, so this is the Bloomberg terminal, Sushil. I wouldn't recommend signing up for this. It's about $2,000 a month, but feel free to take a snapshot of the chart at any point. If you're trading with FXCM, they do have an app called Strong Week. But feel free to reach out to me, whether it's on Twitter, whether it's by email, guys, at any point. I can just easily, tweet that chart, no problem. But to get back to price action, so we were looking for further weakness, near-term support 11,090 or 11,915. That level coincided with a nice Fibonacci confluence here. 11,912 into 15 was our first area of support that we'd be looking for on a continuation lower. Well, we're breaking below that now. Try saying that 3 times fast. Here's what it looks like. So as we noted, the bearish invalidation level 1214, 1219 remained intact yesterday. On its face, excuse me, on its face, this was just simply an opening range trade, a weekly opening range right below resistance. Your weekly opening just below resistance, you test support again, you fail at the opening range highs. Once we broke this level, focus shifts to the downside and we continue to look lower at this point. Now, immediately heading into the U.S. trade session, I do think this thing could slam into a low and give us a little bit of a recovery. Note that you've been getting some divergence in the momentum signature as you've moved lower. So I would be hesitant to jump onto short dollar positions from this point. But on a near-term rally higher, I do think you still look to sell the dollar here for a move back into 11,088, or excuse me, 11,887 would be a basic 786 retracement. And then more broadly, that key support, basic trendline support off the lows from August, and that critical Fibonacci confluence that continues to guide the lows here for the last 2 months at 11,850. Okay, so look, it's going to take the markets a couple of days to really filter in the implications of yesterday. You know, it's all about the slowing of the pace. It really is. The dot plot pretty much is a very strong tell. And you can also tell, let me take a step back. There were some tidbits yesterday during the presser, guys, when she really got pressed on issues of, is the Fed losing credibility? Are you guys waiting for the election? You said that employment is pretty much where it needs to be at Jackson Hole. You noted that the time is appropriate now to begin normalization. Why are you still holding rates low? And with the projections and the dot plots, all it suggests is the Fed is hesitant to move on rates because they do see a risk to broader markets at this point. So that lack of confidence, that push out in the interest rate path outlook is going to continue to weigh here on the dollar near term. Okay. Keep in mind, we do have some Fed speakers on tap tomorrow as we close out the week, so you could get them starting to soften their tone a little bit, which could give a little bit of a lift here to the dollar index, but we'll continue to stay bearish while below 11,955, 11,966, or excuse me, 11,955, 960 with our bearish invalidation, meaning what would shift our focus back to the long side? You would have to break above the post FOMC swing highs, so 11,976 here. So as long as we stay below here, we're bearish. Near-term resistance, 960, 955. A break lower, you're looking for 11,887, and that trend line off the August lows. So Eileen, to go back to your question where you're saying you're surprised, you thought they would want to get the rise out of the way even so. I agree with you. And to be honest, I think they still will have to move in December. Barring any kind of major market disruption, we're still likely to see a December print. That's what the markets are pricing in. That would, quote unquote, save face, right, for the FOMC, which has already pledged numerous times this year that we will see interest rates higher before the close of the year. So I do still think we get that December hike. Keep in mind, 25 basis points. I mean, I personally think the markets can shrug that off without a problem. Okay, any questions on the dollar index on the back of yesterday's FOMC interest rate decision, or any questions from yesterday's sort of presser with Yellen? And they say they don't give attention to politics, but this election, quote unquote, wow. I mean, look, it is what it is. I was kind of annoyed every time I heard that question yesterday in the press conference. Look, they're never going to submit that. They're never going to submit and say, oh, yeah, well, the election's on tap, so we don't want. They're never going to say that, even if it is the case. So we can press them all we want. We can, make whatever assumptions we want. The Fed is essentially supposed to remain, independent, and they're going to continue to talk that talk as long as it takes. At the end of the day, the transcripts don't get released for 5 years, guys. So even if that was the case, we wouldn't even know about it. You know what I mean? And as far as the November release, do keep in mind we do get a Fed decision in November, but it's not a quarterly release. So we don't get projections. We don't get the press release with Janet Yellen. And that FOMC decision is only days before the election. So they're unlikely to move in November as well, which again casts a pretty bright light on the December calendar month. Okay. All right, so that is dollar index. Number one, let's jump into the dollar yen. That was the highlighted setup from last night as well. I had a long on this position. I told you guys here in the report, I said I wouldn't be trying to mess with this just yet, but as we headed deeper into Asia trade, you saw this thing probe below, then momentum started holding 40 or 30 rather, and you saw a nice trigger on the near term that put me on the long position. So the initial target on this, the ATR was about 28 pips. So I took off a little bit at 20. I put the stop to break even, and again, inevitably it pulled back and took me out before it continued higher. But dollar yen still looks good to me, and this is still the major key level that we've been talking about all week, guys. Here's what the daily chart looks like. 100% extension from the decline off the high. Okay, boom, boom, boom. The low day close for July was right here. The August low day close coincided with that 100% extension, and basic trendline support off of the yearly lows coincided there as well. If that wasn't enough, well, you got that 50 line for that long-standing formation that we've been in, just lower. Momentum on the daily chart. Whoop. Momentum on the daily chart coming into basic trendline support. So any way you look at it, I thought this thing was coming into a decent support target. I was on the lookout for long triggers. We got one. Again, took off 20 here on the pullback, got stopped out literally at the pip here before it rallied again. Sometimes playing it too close to the chest could hurt, but either way, it turned out to be a decent trade. So where do we go from here? Again, guys, I'm hesitant to get you too excited on the long side, but I am looking higher while above 123, 129. Again, 129 being that August low day close, 123 being an exact two equal leg, 100% extension off of the decline. So there was that divergence. Here's what it looked like on the 5-minute chart. And this is, I guess, a good drill, guys. I've been getting a lot of questions here in the webinar on, when I say, okay, I'm looking for long positions from down here, a lot of you guys will say, well, Mike, where's the stop? Or how do I know when to get in? Here's a perfect example of trading the turn, as we call it. You saw that price came into that key support, and we sat there for a little bit. I don't know if this is going to break. We're below support, right? It could just plummet lower. So you have to wait for the turns. The market turned up, it rallied. On the pullback, momentum finds support right at 40. It's exactly what you want to see. Okay? And on that break above 50, now you're getting on the long position. We initiate the long. We're looking for about 29, 28 pips. Again, this thing came into the session highs for Asia. So from my standpoint, I just reduced the leverage. I took some of the position off. Now we're getting deeper and deeper into overnight trade. Boutros goes to sleep, stops at break even or just above. I got stopped at break even literally at the low here before we rallied again. But I just wanted to show you the entry and the thought process behind it. You're never going to know, guys. You're never going to get this low. You want to wait for the turn, the pullback, look for momentum to give you some sort of signal, like you did right here with that hold at 40. And that's sort of an indication that we're seeing a near-term shift in the momentum signature. You look for that rally to get out. Okay, if US dollar doesn't get back into 129, won't take it. I'm not sure I understand your question, Eileen. Are you talking about getting into a new long position? If you get a drop into this region, I would be looking again for exhaustion near this region, sure. Yeah. I just don't think we'll necessarily make it all the way back down here again if it's constructive. So at this point, look for a rally towards 101.12. More importantly, the former lower parallel. This is a 30-minute chart. I'm going to take you out into a 2-hour just to show you some reference here. But if you see a rally back towards, or the initial top side is 101.12, this is still a key region. Former lower parallel, former basic. Forget the actual pitchfork. It's just basic trendline support. 1 touch, 2 touch, 3 touch. Break should now offer some resistance right up here. But yeah, Eileen, to answer your question bluntly, I would still be, liking longs from off this level. Where for new longs? Yeah, so this would still be the level of which is going to remain our key support, our near-term bullish invalidation level, and obvious entries that we'll be looking for on possible new long exposure. Now, I caveat this by saying that it is dollar yen, okay? So, you know, expect the unexpected. But if it doesn't go that far, any other places to look? Eileen, so this is where like your near-term analysis comes into play. Do you know what I mean? Let's do this. So off last night's low. Let's just do some quick on the fly here on the near term. Basic retracement. And I also want to see what that extension off the high looks like. Okay, so an area of interest for me would be right here, Eileen. I know these colors are horrible, and I don't know if you can see this clearly at home. Their preset colors are just so horrible. I have no clue why they use these. This is the range I'd be looking for, 145 into 148. So you have a nice confluence there of both the 1618 extension if we were to make a sharper break lower, and a basic 50 from the high or from the low that we made last night. But more importantly, in price, you could see that that's where we got out yesterday. That was the opening range high for Asia, and that was indeed the Asia highs. Okay, we didn't break until the open, or I guess let me take that back. That was the Sydney highs. Asia broke higher later in the session on the opening range break, but a big region near term. So if we do get a drop into like 145, that region near term, you might see some possibility for some support there. But I don't, trading, let me take a step back. The stop, Eileen, you'd still want to treat it like here. Wait for the drop, let it rebound, wait for the pullback so you can get a stop against that low. I wouldn't want to just buy into that dip. Same thing as we did down here yesterday. Okay? And this is really near-term price action, guys. I mean, we're doing analysis on a 5-minute chart here, so don't get too excited just yet. No, that's no good. Does that make sense? And watch for RSI triggers. Exactly. Yeah. Eileen, we on the same page? What I needed. Makes sense. Okay, cool. Cool. All right, so any other questions on dollar yen? Broadly looking higher while above this 123 mark, 129. You really need to get above 101.50 to really get the reversal confirmation in dollar yen. But a pretty clean trade just over the course of the last, over yesterday. Our bearish invalidation held like a charm. The weekly opening range break was like a charm. And, here we are into key support. So look for that rally to start materializing, hopefully off the low here. Okay. If there are no other questions on dollar yen, let's move right on. That was number 2. Running a little late on time here. Sterling dollar. Here's the British pound look like. Also, a big reactor that we saw yesterday identified this new slope off the low last night. I don't want to put too much emphasis on it, but for me, on my part, I am looking higher while within this near-term formation. So this is just a basic pitchfork off the lows we made for the start of the week, the high, the low that we made subsequent. You can see some sliding parallels here, catching some really nice wicks. Here's what the British pound looks like right now. Okay. I bailed out on this trade way too early, which is kind of, again, kicking myself there. But here's what it looked like. So on the actual release of the FOMC here at 2 p.m., this thing came into, again, the lows and failed. And on that wick, it was a pretty strong tell. I mean, I didn't get an entry right at the low. I know it looks like it did, but I didn't get an entry right at the low. But after it failed, for me, guys, this is a pure risk to reward ratio trade. Literally. We got in at 129.68. The stop was against 129.48. So like a 20 pip lob for a much, substantial, much larger gain expected, just because we were coming to this resistance. This was the third time that we were failing. Momentum was showing strong divergence into the lows, and with a 20 pip stop, why not? So we kind of jumped into that one right on the back of the FOMC announcement. Keep in mind that obviously, because we're a day later, it doesn't show you all the exits. But there were two exits. The first one was at 20 pips. The second one was at 30 pips. And then the final trade got limited out last night, at the 65 pip target there. Long story short, this is the problem with limits. If you're not watching price action in the near term, this was actually still quite constructive. And price action was coming right into support or momentum is coming right to support the 50 line, which continued to hold all night essentially. But the rally now extended into the first target that we cited last night, and that first target was right here at 130.86. So far, the high that we just made was 130.86 on the dot. Okay, so look for possible near-term pullback here. I like this thing constructive while above this sliding parallel right now. Yesterday, we liked it higher while above 130. I'm going to raise that to this parallel just on account of the rally we made. And this is going to be our new bullish invalidation. So as long as price action stays above the weekly open, the 130 handle, I still like buying pullbacks targeting 131.36 and basic channel resistance. As far as UK data is concerned, you're pretty quiet for the remainder of the week. So again, look for broader dollar price action to really be driving this pair. Even next week, actually, it's pretty quiet from UK data. Carney still on tap today. That's right. Eileen, thanks for that reminder. Eileen also says, me too, bailed too early, but learning caution from you as well, learning to see other signals now. Cheers. I'm happy to hear that, Eileen. I'm not happy that you bailed out early, but I'm happy to hear that things are working out. Yeah, I mean, you're not always going to catch the entire move. And this is why I'm a big advocate of taking some off, bringing your stops in, letting it sit. Okay, if I had done that yesterday and maybe left a little bit more on the table, we would have woke up this morning with a nice extra 20 pips here to the upside. But no one ever went broke booking profits, so I'll always err on the side of caution. Okay, any questions on sterling? Cheers, Eileen. Right on. Okay, so that was number 3. I do want to take a quick segue real quick, guys, and just talk about Pound Oz. I'm sure Jamie will talk to you about this today in his midweek strategy webinar. A quick reminder for everyone in the room, 1 p.m. Eastern today. Jamie will be on with his midweek strategy webinar. But just a quick reference, Pound Oz is coming into a critical area of near-term support. I don't have a position on this yet. As a disclaimer, I am interested in getting long. Again, waiting for the turn, right, as we just discussed on the dollar yen. So the level is defined essentially. It's essentially where we are right now. The low that we made back here in July, that low registered at 70.44. That's not the August high day close. I'm sorry about that, labeled wrong. But that is the July low. That coincides with the lower parallel here of this formation off the highs, and a near-term parallel just off the highs here, which again, we don't know if these parallels are in play, right? Because you haven't gotten too many pivots just yet. But certainly they both coincide all right here. If I take a basic retracement off the lows into that level, it's a little bit lower down, but you also have the 764 retracement right there at 69.76. Okay, so an area of interest for near-term support in Pound Oz. With the same respect, if this breaks, you're likely to see some free fall here. Okay, so what does it look like on the near term? Here's what it looks like. We're getting mounting, building divergence off the lows, price action continuing to make lower lows as the oscillator makes barely higher lows, but higher lows nonetheless. And I'll be looking for signs of exhaustion here heading into the U.S. Open. If you get the rebound, or if you get the turn rather, we're going to be looking to buy that dip. Essentially, if you do, the first thing you do is tack on a basic retracement. But let me address this chart for you real quick. Again, there's that same 764 we were looking at on the daily chart. Just want to also show you a parallel extending off that high. Also coincides right there. And again, that low that we had on the daily chart. So here are the levels sort of that you want to keep in mind near term. The weekly open is the breach that you would need to validate basically a reversal. But near term, I'm looking for signs of exhaustion, looking for long triggers and near-term momentum while above 69.77. This is the, last-ditch effort, guys. If it breaks here, don't even try to get cute with this one. It has a wider ATR and is likely to see a steeper drop if we compromise this level to the downside. Any questions on Pound Oz? It's number 4. Okay, up next from last night's update was the Aussie dollar. And here's what the Aussie did. I did get stopped out on an Aussie trade last night. That was a break-even stop. Look, it was coming into a big resistance. And, momentum was showing a little bit of a hold, but not something too conviction. So I did jump in pretty quick. Once the market gave me literally a 10-pip gain, I just threw it at break-even and went to sleep. Later on that night or last night, it did stop me out at break even or rally harder, but we're breaking an interesting area here, guys. And you guys know, especially those of you who've been with us for a while, we've been liking the Aussie long for a while. We just never got the chance to get in. Looking for a pullback initially for the week into 73.80, didn't happen. Once we got the break to the upside, we were looking for a pullback into the monthly open, didn't happen. Even last night, I was still hoping for the pullback here. I was on the short just looking for a pullback to get long inevitably at the end of it, but we didn't get it and it plowed right through. So long story short, I'm looking at this 2013 trendline resistance, which is up and coming right now. Just zoom that out and show you where it's coming off of. Right there, okay? We tagged that earlier in the month. That's sort of your next target on the upside for Aussie dollar. I do think this thing does, give us a little bit of an exhaustion blow off and a pullback. But from these levels, guys, if you take into account the near-term chart, I don't really have anything, a conviction level to trade against. At this point, I'd be looking for the August high day close at 76.98, a sort of a level of, I would start to look for possible exhaustion. Either way, a steeper pullback here would hopefully give us an opportunity to get back on the long side for Aussie dollar. So a non-event for me yesterday, and unfortunately, but we'll be looking for an exhaustion pullback here near term. Any questions on Aussie dollar? All right, that is number 5. Okay, next up on tap, dollar CAD. And another one that broke the invalidation level for the long side of the trade. If you guys remember 131, we were talking about yesterday, even as low as 130.80 for an area of interest to find some more stringent support if this is going to hold. That broke, kept the short side in focus, and that last ditch effort at 30.35, it looks like we're peaking below it right now. I know this chart looks a little messy. This is what we were working with earlier. This pitchfork right here has been added, a fresh add. So we were looking at this. We broke that lower parallel basic support, came back, checked it as resistance, and moved lower. If this formation was in play, because you saw the 50 line catch the highs here pretty nicely, that would have been, again, an area of near-term support, which we've compromised. So I'm not really favoring using this slope at this point either. Rather, I'm kind of sitting on my hands here for dollar CAD at this point. Below 130.85, below 131 now, the risk remains lower. Okay, momentum is obviously shifted. This is the first break into oversold territory that you've seen since back here. Even on the rally since the start of the week, you got a pretty pitiful try to break above 60 here and a hold. Again, the momentum profile also keeps the focus lower in dollar CAD. So I don't really want to touch this. I'm just giving you guys an update on it right now. I don't really want to touch this right now. If you take a look at crude, Conwall, this is crude for you. Number 6. Here's what the crude oil trade looks like. Conwall says, Michael, I'm long in crude from 45.50 with a target at 146.34 and second target at 46.44. Is it okay, or your guidance? Okay, Conwall, so I do like those levels. I have 46.40 as that swing low, but it's been a decent pivot in price and comes right ahead of the key 618 retracement of the entire decline from the highs. So I like both those levels within the zone of 45.40 into 45.58. Yeah, I like that. I would have to say I like that. Okay, remember yesterday we were talking, right? In the webinar, this was sitting right at resistance at the monthly open, right? And as long as that resistance holds, we really couldn't get excited on the long side. But guess what happened? You got a momentum break above 70 in and of itself, sort of a break trigger. And then you came with that rally through the 38.2. You're right. Next top side targets, 46.40 into 46.58 in my humble opinion. Conwall, does that help on crude? And again, that continued crude strength, whether it's dollar weakness or crude strength, you could expect to see that dollar yen, or dollar CAD rather, excuse me, could see and suffer further losses here as CAD finds a little bit more of a firmer footing. He says, yes, sir. All right. Yeah, the crude trade's been pretty clean. Can't really complain too much. Watch this also, Conwall. I added this piece here. Let me add that to the demo chart, or the scalp chart. So this level is just a basic trendline resistance extending off the highs from August and actually coincides dead on with that 618 retracement later in the U.S. trade session, or later this week, basically into tomorrow. All right. As always, feel free to take a snapshot of the screen here, guys, if you need these charts for any future reference during the course of the day. Okay, crude was 7. Let's go back and take a quick look at the Kiwi dollar. Obviously, the RBNZ came out yesterday, hold on rates. But interestingly enough, they did say that they leave room for further easing, and essentially that further interest rate cuts will be required, I think was the exact quote that came out. So nothing out of the ordinary. If you take a look at the overnight swaps, we're still expecting that 2017 cut. Nothing really ahead of the end of the year. And you didn't see too much volatility, although the Kiwi did start to turn over a little bit. Remember, nothing's changed on the Kiwi dollar. The basic premise of the trade coming into the start of the week was the fact that we had broken below basic trendline support, and below basic trendline support, now resistance, the risk remains to the downside. Okay, with 73.80 as our bearish invalidation level. That's the high from August trade, a longer dated 764 retracement, and heading into the end of the week, exactly where that trend line is to the upside. So, the basic play for a Kiwi dollar has just been, shorts against 73.50 every time you got up there. And it's been working pretty well. So again, last night we tried to probe through that 73.50, 73.60 key near-term resistance zone. You probed just higher into 73.69 before turning over. Again, this is post-RBNZ. At its face value, again, the weekly opening range, in my humble opinion, still looks to me like it's intact. And I'm still going to use that trendline resistance, former support, as our bearish invalidation level. As long as we hold below that, each rally into that, I'm looking into short triggers. Also note that on the last two peaks here, momentum made some clear-cut divergence. Price action making a higher high, the oscillator making a lower high. So still like the short side of Kiwi. Cherry pick your entries here with as close as you get stop against that high. But inevitably, if you are holding stops or shorts right now, your limits should be right back at key support, which we've continued to pivot off of for the last 4 weeks. And that's the March 2015 low day close and the July high day close at 72.92 into 72.96. So still looking for short triggers here in Kiwi dollar and heading into the U.S. session. Keep in mind, heading into the start of next week on Sunday, you do get the trade balance figures from New Zealand. Here's what those are supposed to look like. Not typically going to be a major market mover, but because of the print that we got previously, we'll be looking to see if that does shake markets up. Again, that's on the 25th. That's going to be Sunday night here in New York, shortly after the open. Any questions on Kiwi? That's number 8. Okay. Last but not least, I do want to just go over gold, and then I'll take a look, Alan, for you. You're still in the room? Yes, he is. We'll take a look at the Aussie 200. But first thing is first, here's what gold looks like. I know a lot of attention has been cast on this trade, especially in light of what happened yesterday with the Fed, and you did see that topside break go through the low day close at 130.30 that we were talking about. That's now near-term support, and you can see that we actually already rebounded off it here today. Look at the pivot we've made at 130, guys. Irrespective of it being the low day close of July, the low day reversal close, by the way, really nice pivots in price. So we're back above that. Near-term resistance now, the high day close for this month comes in right here. Okay, that's 1350. Remember, the high day close for the year is 1355, and that's the validation for the breakout for the broader continuation of this massive uptrend that we've been in gold from last year's low. Okay, bullish invalidation still unfortunately needs to be against yesterday's low, the monthly open, trendline support, you name it, it's all down here. Initial support should be right along the median line. So I'd be looking for like 1315, 1320 as initial support with our bullish invalidation still at the monthly open. Near-term resistance 1350, a break above 1355 is needed to get sort of the validation for the breakout. If the dollar continues to tumble lower, inherently, guys, expect gold to stay well supported. Okay, it doesn't make too much sense to get increasingly bearish on the dollar and increasingly bearish on gold. Now, they can move together. Historically, there's plenty of times where they move together. But in this environment right now, you're likely to see them move tangent. Why? Well, the dollar is losing steam because of interest rate expectations. Gold is moving to the upside because the fact that the Fed has reduced its forecasts, is more concerned about hiking rates. The hike rate or the interest rate path looks now flattened, so you're catching that bid in gold a little bit, right? So the dynamics are such right now where you could see dollar weakness fuel gold strength. Okay. Eileen says, besides yearly high day closes, are the monthly high day closes and low day closes good a couple of months back, or how far? They're always going to be something I'm going to take a look at, Eileen, at major highs and lows. But for the month that you're in, typically it'll be something that you'll want to pay attention to. So the high day close for this month. And for me, it's not duration, it's the high. So Eileen, I'm not going to necessarily stress last month's high day close, right? Because the actual yearly high day close comes in just 1 month previous. But for the near term, objectively, right now, this month's high day close is important. Does that make sense? The most immediate high day close is something I'll always take into account, but the more important ones are the ones that are going to be at major highs, like the one for the year, the one for the major turns in price. So for example, on the way down, Eileen, I'd be looking at this low day close. You know what I mean? But the immediate one and then the yearly one are the two I'll be looking at on this near-term breakout. Okay, yes, makes sense. Right on. All right, any questions on gold? That's number 9. Okay. Alan, here's Aussie 200 for you. I don't really follow it closely, so I'm just going to bring it up. If we need to, we'll do some on-the-fly analysis here, but bear with me. Okay, so you're checking resistance right now at the monthly open. The monthly open, Alan, comes in right here, man. It's like 5403. So you're checking that as near-term resistance right now. If this breakout is legit, you'd want to stay constructive above yesterday's close. If this is a true breakout of this descending formation. So this could simply be a false break scenario, this whole drop right here, below basic trendline support, the lower parallel, and then you could see that this descending formation almost caught the lows to the pip here, okay, in this confluence region, which is the 50% retracement of the advance off the lows and the lower parallel for the current operative structure. If this is going to be legit breakout, you'd want to stay constructive basically above here. Now let me just see if there's any Fibonacci relationships on this move. Disgusting. Okay, there's the 2618 extension, literally caught the lows to the pip. So the fib relationship there offering clear-cut support near 5153, 5162. Ha! And the December high. Wow, you got a lot to look at here. The December high from last year comes in right in line, and I'll use that. We'll work with that as our near-term bullish invalidation. This 100% extension you don't want to stress. Whoops. And let's take a 4-hour look at the chart here. Okay, there's no structure to the advance just yet. Typically, I like to see a little bit more of a build with some structure to the advance or the decline. This is real near term. This is real near term, Alan, but you could be working with something like this for now. What it does highlight again is this region of support here, near term targets here. And I just want to go back to the daily and see. Okay, we just broke the 100-day moving average too. So yeah, I would say look higher above 53.58 near term as support. Topside target initially 54.44, and that's the key 618. It's backed pretty closely by that low. I'd be watching this as well at 54.60, 54.59. All right. I hope that helps. Alan, let me know if you have any specific questions on that. He says, cheers, Mike. Yeah, you're more than welcome. Do you need a screenshot? Feel free to take a screenshot of the chart here. And then let me get you back to the daily and get rid of this so you can get a little bit clearer picture. Take another screenshot right there and you're good to go, buddy. Cheers, mate. All right, that's Aussie 200. That's number 10. I got a question here. Comwall says pound yen. Oh, how did I forget pound yen? Where is my mind at? Pound yen, pound yen, pound yen. There we go. Sushil, do you trade Swiss? Sure, Sushil. I trade anything that has an active setup on it. I don't care if it's seashells. If there's technical clarity to price action, I'm all over it. That being said, Sushil, I'm not a fan of the Swiss by any means at all as of late. As for the last couple of years, since the whole peg thing and the January 15th, 2015 debacle, I haven't really traded any of the Swissy pairs. Sometimes Dollar Swiss does have some active setups, but to be quite frank with you, it's probably been over a year that I've personally placed a trade on a Swissy pair. That's just that's just you. That's just me. He says it's very choppy, long pin bars. Yeah, it's you know to a degree, guys, you can say that the central bank has their hand in every market. But with the SNB specifically and that peg and the impact it had, that was the largest currency move we had seen previous to Brexit. With the central bank that's so finely ingrained with what's going on in the FX markets and direct intervention, it just doesn't make sense for me. Kind of it's a perversion of the markets. And as a technical trader, it really makes me doubt, or it shifts the focus away from price action and more so on, all this nonsense of what future policy might look like. So I'm not a big fan. On pound yen, he says, I saw that, luckily. Mad E-money. Yeah, he says made money. Yeah, I mean, just be careful. I don't want to deter anyone from taking an opportunity if it's there. It's just that, the Swissy in general for me is just not necessarily my favorite pair. So pound yen, you guys know we talked about this yesterday. We talked about the uncovered close at 130.81. We talked about the 2016 low day close at 130.96, and we talked about that being a region of which the last-ditch effort, and we would like to see some support for pound yen. It looks like you're getting some initial support. You got some nice divergence into those lows, with price action making a much steeper low, oscillator making a higher low. Does shift the focus to the upside, but you don't have clearance for a reversal yet. If anything, this I would have treated as a scalp, and I'd be on my way out at this point. For us to break, let me take a step back. For us to validate a reversal, I would need to get back above the weekly open, which is essentially like 32.79 here, 32.80. So let's see if we can amend these levels. Bear with me just one moment. I'm going to go ahead and get rid of that retracement altogether. And now that we've made a near-term concerted low, I do want to see what this retracement looks like. Get rid of 38.2. We'll leave that 50. Okay. And what's this 50 here? That's done. Okay. These are the amended levels I'd work with for pound yen. If you need to take a screenshot, this highlights key support, key resistance near term. So, I'd bring that down from ahead of the weekly open. I'd say near term, look for resistance at 132.40. If that breaks, the weekly objective opening range high becomes the resistance barrier to get. Okay. Here's your weekly open. So that's sort of my game plan here for pound yen moving forward. This is a big old outside day. It wasn't a reversal day, but it was a big old outside day that took us into key support. Momentum, I don't know. That looked like a break to me yesterday. It looks like it might be, looks like it might be recovering here today. So I have my doubts. Who is this for, pound yen? Conwall, but I do like the upside in generally speaking, while above 130.96, 130.92. I'm looking to buy pullbacks on this. Kind of in line with the dollar yen position I was in yesterday and the pound dollar position I was in yesterday. This actually might have been a decent substitute to reflect that opinion on both the pound and the yen. But yeah, I do like it higher. Look for resistance at 132.40. Any other questions before we wrap things up? We made good time today. Hope I wasn't talking too fast. A quick reminder to everyone in the room, you still have Jamie Setley on tap at 1 o'clock today with the midweek strategy webinar to go over some of the longer term swing trades and implications post the FOMC policy from yesterday. And if there are no other questions, I'm going to go ahead and wrap it up right here. Guys, best of luck trading. We will see you. Quick reminder, on Monday mornings, the free public webinar is on Daily FX, guys. I do tweet out those links on both my Daily FX, my personal handle, and on the SB Trade Desk handle. So keep an eye out for that on Monday morning at 8:30 Eastern. And we'll be back right on here on SB Tuesday, Wednesday, and Thursday morning for the intraday strategy webinars as regularly scheduled. Till then, best of luck trading. Have a great weekend. We'll see you next week. Cheers.